First rates will just start coming up on your screen now, and it's a cut of 100 points on the Nifty. It's a cut of about 300 points on the Bank Nifty. What do we have on the market breadth? 900 advances, 440 declines. Banks, HDFC Twins, please. They hold the key for the Nifty. And HDFC Bank down 5%, exactly in line with what pre-opening rates were indicating. And HDFC Limited down 4%, 4.5%. Let's see where this ends for the day. Railway stocks now, then Dabur, Hero MotoCorp and TVS, some more stocks which are in news today. RVNL down 0.5%. You've got REITs up 0.5%. IRFC, I mean, it's not like the most important go-to stock, but volumes have been very strong. Mircon is up by about 0.25%. So railway stocks are moving against the market right now. And now let's look at TVS and then Hero MotoCorp, just to establish where the prices are. Hero MotoCorp is flat. I will not be surprised if it gains weight. In TVS, despite these numbers, which are not great, surprisingly the stock is up 4%.
Yeah, a good 5% higher for TVS as we speak right now. Loads of other stocks which are going to be in focus as well this morning. Hero MotoCorp, I think Nikun just flagged off. The Q4 earnings are a beat on all parameters. Margins have seen an uptick of about 180 basis points. Still very tempered a move on Hero MotoCorp. Tata Power, what are those numbers up to? Considering it was a beat again over there, the EBITDA has come in higher by 3.3%. About a 0.5% uptick is what you're seeing on Tata Power. The Zydus Life as well, which has got the final US FDA not to manufacture and market one of their key tablets. Zydus Life will just come up for you on your screens. Good earnings reactions from a Seat, from a Sundaram Fasteners, from Blue Star, and from even Aptus Value Housing for that matter. All of these should be seeing a positive reaction come by. Good move on Blue Star, in fact, as I see on my screens. Seat, Aptus, all of those stocks holding up very smartly in trade. There's also United Breweries, by the way. The Q4 volume growth has come in below the estimates as to what the street was penciling in. It's come in at 3%. The EBITDA is down a good 79% on a year-on-year basis. 3.25% lower for UBL as we speak right now. Manappuram Finance is the other stock which should be reacting now to the money laundering allegations against the company. The ED, remember, has frozen about 143 crore rupees worth of assets. Manappuram has gapped down another 10% as we speak right now. J&K Bank, not such impressive numbers, nor is the case with 360 One Health. So the J&K Bank is holding up 3.25% as we speak right now. So then, where is the index settled in with the knee-jerk reaction that you're seeing on HDFC Bank? Although ICICI Bank, Axis, Kotak, SBI, they're all in pole position as we speak right now. But yep, Kunal, HDFC Bank weighing heavy on the index.
Yeah, weighing heavy, and I think that initial set, the loss for HDFC and HDFC Bank, I think has been set off by ICICI Bank. I think the stock made a new high or sort of a fresh multi-week high about the 940 odd mark. On an initial opening take. So hopefully we can expect that the other private sector banking names could probably start to get into an upward move, trying to offset the losses from HDFC Bank. But I think it's still an okay start for the indices given the handover from the US markets, a 100-point downtick and a 300-point adjusted downtick on the Bank Nifty, still an okay start. The stock which I would look to trade in the open would be Glenmark Pharma. I think the stock has come back towards a very strong upward trending mode. In the last 2 days, it's retraced mildly, I think 2% or 3%. So I think at 544 levels, looks very attractive for a contra buy.
Okay, so that's the first trade coming in from Kunal, Glenmark Pharma. But what about you, Naresh? What are you spotting?
So that would be a buy on Container Corporation. The stock has given a 3-month range breakout, and like all the PSEs, one by one. So Concor could be the one which could see a move in the short term.
Okay, Naresh, your take on a couple of these other names as well, which are opening with a bit of a downtick. Manappuram Finance, it's now around that 110 rupee mark, and BHL as well. BHL was having a great time, at least over the last 2 days, but today it's down about 5%.
So BHL would be looking out for a buy around that 80 mark. The stock has seen a good breakout move in the last 3 sessions. So closer to 80 would be a re-entry point. In terms of Manappuram, not really wanting to catch this as such, but 105 should be a tough one to break. So I would expect some bit of a reversal from 105 levels.
So Those are the top technical recommendations, but let's get you some fundamental opinion now. Financials and manufacturing are the mega themes for the coming decades. That's the word coming in from ValueQuest Investments' Ravi Dharamshi. Listen in to his latest views.
I think out of the $40 billion outflow that happened, $20 billion went out of financials. Now you just juxtapose it with the fact that US regional banking is facing a severe crisis. The larger banks are being called upon to support the smaller banks. And of course, yesterday Fed made a statement that, that was an exception. It's not likely to happen. But what that tells you is that elsewhere, there are problems created by the lending sector. While in India, it is the strongest sector. In fact, nobody talks about an asset quality deterioration or any of those things. All we keep discussing is, will there be an impact on the NIMs? Is the growth going to be high enough or no? And in fact, I find financials as the only place in the market where there is a combination of growth as well as value. Most of the places have growth, then the valuations are not in your favor. Or if the valuations are in your favor, then there is no growth on the horizon. So financials is the only place which has growth plus value and will be the first port of call for any foreign money that will be coming into India. And I think what will happen is maybe the second tier and the third tier run in the financials will also start benefiting from this. So now we are witnessing probably some change of guard. We have already witnessed a change of guard in the large banks. Probably we are going to witness a change of guard in the large NBFCs as well. So some of the performing ones will probably get outpriced before they even come down.
Or are we from a real recovery in pharma where you would say that the excitement of 2021 is over and the pain of 2022 is something what markets have factored in?
So we had almost 16, 17 months of consolidation period. So clearly we dealt with the storm in a very, very mature way. It was more a time correction. We have digested all the bad news and we have digested the euphoria of 21 as well. See, there were some sectors which ended up, or some companies that ended up losing 50-60%. Otherwise, most of them managed to hold on to their gain with a 10-20% kind of a loss. So I think that period of correction, consolidation is getting over. The period of wealth creation is coming back as RBI has already paused, and some of the other factors of profitability are also coming into favor. So basically, see, India never had a balance sheet problem. India only had a P&L problem, and that was coming from the raw material inflation, freight cost increase, and some slowdown in growth. I think the raw material inflation has already eased, freight cost has already come down. The growth slowdown that has that came about has kind of been factored in most places, but there is probably export-facing sectors still have some amount of growth slowdown, maybe a couple of quarters. But besides that, I think at an aggregate level, India has recovered very well. And once growth comes back, in fact, the operating leverage will also come back, with leading to margin improvement. In fact, this quarter, we are already witnessing some of the leaders in industrials, manufacturing, auto ancillaries, financials are seeing some margin expansion, which was not an expected phenomenon, I would say.
Ravi, hi, morning. We've sort of borrowed this line from you, the manufacturing renaissance, as you so well described it. And, you've talked about some top emerging themes in order to capitalize on this manufacturing growth. So can you just, walk us through what exactly those are?
So, I think confluence of factors. One, China wants to move away from manufacturing. Maybe it is because of pollution issues, maybe because they want to move their economy away from export-oriented to consumption-oriented. China wants to move away. Second is, world wants to move away from China in terms of their dependence, because of their over-dependence on supply chain terms on the China. And India has a huge populace that needs employment, and the kind of employment that manufacturing can generate cannot be generated by services sector. So we have no choice but to grow our manufacturing sector. Now, government is taking all the steps required to give the boost to the manufacturing sector. But it is not an easy journey. But we are already witnessing some early signs. So for example, in electronics, I think we are in mobile, especially within electronics, we have become net exporters. I think that's a huge benefit for Indian economy. So we had a structural issue because we always used to run deficit versus most of our trading partner. And the number 2 item after crude was electronics that we were importing. And if we can start within electronics, mobile was the largest component. So now if we can start that manufacturing locally, I think we have a very good chance of correcting that structural flaw in the economy. So I think beneficiaries of that, the domestic electronics manufacturing outsourced vendor is one place that really excites us. I think there is a long runway. These companies can continue to grow at 30-35% kind of compounded for a long period of time. And so yes, valuations are not so cheap from current earnings perspective, but I think the absolute size of these companies are still very small, and over a 8-10 year period they can really become larger. Something similar that happened in the chemical sector from 2014 to 2022. We had an 8-year fantastic run, and these companies went on to become really large. So, and they were getting more and more expensive along the way, but they stayed expensive for a long period of time until last year. So I think we are at the beginning of that outsourced electronics manufacturing in India. There are two issues with the IT. One is obviously the margin contraction because of operating deleverage playing out, and the second is the growth. I feel the growth slowdown yet is not completely factored into the IT companies. Also, we are not very clear. Fed might say that they might have a mild recession, but interest rates going from 0 to 5.25% in one shot in the shortest period possible. We don't know where this pain will show up. Right now, it is showing up in the regional banking sector, but tomorrow it could be something else that could start hurting. So I would wait and watch before concluding that this is only going to be a mild recession. And also valuations probably will get a little more attractive from here as well. If nothing, that at least time correction has to be there before we can say, okay, the worst is over for the IT sector. Clearly, IT is a mature industry, and one has to accept that we are never going back to maybe 17, 18, 20% kind of growth. Yes, there will be some companies within the sector, the mid-sized companies or the small-sized companies that can grow faster. But as a sector, I don't think we can expect beyond 8 to 12% kind of range. In very good times, it might be 12%. Otherwise, it will be more closer to 7-8%.
Anand Goenka, Vice Chairman with CEAT, now joins us. Let's connect with him to understand that what is the way forward for the tire industry, how things are shaping up, and what kind of incremental changes we should expect from this sector going forward. Mr. Goenka, good morning. Thank you for joining us. Haven't met you in a while. So how are things at your end? With these numbers, I'm sure you'll be a very happy man.
No, thank you. It's great to see you, and certainly nice to see a bounce back in terms of performance. It's been a challenging year and a half, with raw material prices having gone up a fair amount in a very short period of time. But with that having stabilized, I think we've been able to see better margins. Growth in the last year has also been very attractive at about 20% plus levels. So certainly at a happier position right now.
Was the last financial year tough on the demand front and also on the raw material front, or it was only the raw material challenge?
Right. So it was quite a volatile year. The first half of the year was very challenged because of sharp increases on the raw material side. The second half of the year, things started to get better, and then we started to get the benefits as we consumed the lower priced raw materials, which came into Q4. So to that extent, margins largely improved quite sharply between, say, Q1, Q2, and Q4. On the demand side, I'd say demand has been mixed. We cater to three segments. The OEM segment has been very attractive all through the year. I'd say led by commercial vehicle doing very well. Passenger car segment also shrugged off the semiconductor issue to a certain extent. The two-wheeler segment on the OEM side, though, has been relatively slow for the last 2 or 3 years to a certain extent. But overall, OEM growth has been at 25-30% plus kind of growth rates. The second segment we serve is the replacement segment. I'd say their demand has been kind of at GDP kind of levels, normalized kind of growth rates that we're seeing. That also is a reflection of what happened with respect to OEM demand in the last few years' time, which has been affected because of the various rule changes that have happened because of COVID, etc. And exports towards the second half of the year started to get weaker because of recessionary trends around the world, because of currency devaluation in some of the developing world. So these had an impact on international business demand as well.
For a tire company, there are two large components. One is carbon black, a crude derivative. I'm just breaking it for our viewers. And second is rubber. And on both the front, things are looking up. So as we move into the future and if raw material prices stay where they are we looking at an exponential jump in your margins and profitability?
So just to add, I'd say about nearly 50% of our raw material are crude derivative products, not only carbon black, but whether it's rubber chemicals, nylon tire cord, etc. So 50% is crude, about 35-40% is natural rubber. I'd say the raw material prices have kind of bottomed out at this point of time. We're not expecting any dramatic increase, but we expect it to be range bound going forward. So I'd say that margins will be hopefully a little range bound to that extent. We don't expect a dramatic increase in margins going forward. Crude, I think at about between $80 and $85 is what we're seeing it. Natural rubber today is at about 150, 155 rupees per kg. It's gone up a little bit from about 140 lows in the month of, say, December, January that we saw. So I'd say not a major change in terms of raw material prices as well as margins for the next visible 1 to 2 quarters.
Quite interesting, Anant. In fact, we were just chatting while you were talking about your assumptions on crude. You perhaps are the best one to get in for commodity shows as well. Quite an expert at that.
No, not really. I think it's just around the areas that we focus on and that affects the tire industry.
Oh yeah, absolutely. You have to gauge it minute by minute, I'm assuming. But tell me, while you are making that assumption that commodity costs may have bottomed out and demand, I would say, is still a little bit wobbly, what do you do to your capex then at this juncture? Do you not invest in capacity expansion for the year ahead?
Right. So we've had a very large capex cycle over the last 3 to 4 years' time. We've invested nearly 4,000 crores. So in fact, we are quite uniquely positioned that the capex that we have about 20% upside in terms of capacity utilization now. So as demand picks up, we may not need to invest much more in terms of capacities, whether it is on the passenger car, two-wheeler side, off-highway tires. These are areas that we have been investing and we have upside. So certainly I'd say earlier where we were doing about 1,100 crore capex per annum, that may get normalized to say about 700 crores, 600 crores going forward. And that would be relatively smaller brownfield expansions that we will need to do on a regular basis to grow.
You touched upon the international geographies. What's the outlook with respect to exports going forward? And also you were expanding your presence when it comes to tapping the opportunity in the EV vertical. Plans around that?
Right. So I think the exports is seeing some amount of uptick now. The last 4 months has been challenged, but I think things will get better going forward. Maybe not very dramatic shift, but I think in our case, we've been investing a lot on EU, a little bit in the US for passenger car segment, on the truck segment, and a lot on the off-highway tire side. So with our investments in these areas, we are very optimistic about the growth in international business. We want about 20 to 25% of our revenues to come in from international business. So we feel quite optimistic and positive on exports. With respect to EVs, I mean, it is there to stay. We are seeing a clear shift from the two-wheeler side. In the last year and a half, there has been increased demand on the passenger side. I think if you go out on the streets, you see a lot more green plates versus the whites in that sense. So that clearly shows that there is some shift that is happening. And we are very committed. We have a range which is launched on the two-wheelers, on the passenger car, and on the truck side in terms of our EV presence. And largely, I think these tires require better rolling resistance, low noise, ability to cater to heavier loads and so on. So our products are very well catered for the EV segment, and it's very, very important for us.
3 years down the line, more than 20% of your total business comes from EV, whether it is export or domestic, but it could be EV. What changes for you then? I mean, will it be a change in margin? Will there be a change in realization? What changes if the EV portfolio grows?
Right. So as the EV portfolio grows, and if we are more focused or have a larger share of business, say with the OEMs at this point of time in the EV segment, that will of course reflect in the replacement segment going forward. The second change that happens is EV vehicles are much heavier. They have a higher torque, and therefore the wear and tear of tires is higher in the case of EV. That will mean a shorter life cycle and therefore hopefully longer demand of tires over time. Of course, we will use our technologies to make sure that the life of the tire continues to remain very long, but inherently, with the weight of the battery being so high, the wear and tear of the tire will certainly be higher than in an ICE vehicle.
That's the other thing, actually, Anant, I wanted to talk about, because much like commodities, you would have a fair, clear picture on auto as well, right? Because there have been some changes in your product mix from FY23 to what you did in FY22. For instance, the contribution of two-wheelers and three-wheelers have declined by 200 basis points. And for passenger vehicles, they've actually up 200 basis points. How do you see it panning out for FY24? And if you could throw in the EV segment as well.
Right. So this shift has been happening largely because of market situation. Our intent is to keep growing more and more on the two-wheeler and passenger car side. The two-wheeler market itself has seen a slowdown. So to that extent, that shift happened. But we want to keep gaining market share on the two-wheeler and on the passenger side. So over time, if two-wheeler plus passenger can be about 40% of our revenues, today it is somewhere around that level. So take that up maybe to about 45%. About 15 to 20% we would like to get from OHT tires, which is a high margin segment, largely catering to EU and US markets. So with all of that, if we get a strong market share position as well as a strong margin position in these categories, we'll have nearly 60 to 70% of our revenues coming from areas where we are strongly positioned in the market as well as higher margin categories. With respect to EV, I think for us on the two-wheeler side, we're there with nearly 80% of the EVs. Our market share with the OEMs will be somewhere close to about 50%. So as and when this comes into the replacement market, that will also be visible in terms of replacement demand in about 1 to 2 years' time.
Anand, just before we let you go, you clocked in a revenue growth of 20% for year FY23 and the exit rate of gross margin is around 40%. Going forward in FY24, will this 20-25% growth rate continue and gross margin between 40-45%?
Right. So with respect to the demand side, a lot of it came because of inflation and price increases. With raw material having stabilized, I don't see this inflationary impact and price increases coming into the coming year. On the demand side, I think demand is also relatively muted. I'd say we're coming out from a low base because of the COVID years in FY22, which affected FY23. That's got normalized in FY23. So FY24, I think we expect, high single digit, low double digit kind of demand growth and not really a 20% plus growth that we've seen in the last year. With respect to margins, we expect margins to be relatively stable because we are seeing some stability in raw material prices. We don't see much pressure in terms of changes in terms of selling price at this point of time. And we're working in terms of our own cost efficiencies that will hopefully also have some positive impact on margins.
When your large capex, your margins are improving, which means you'll be generating a lot of cash. So what would you do? Retire debt or pay it back to shareholders?
No, currently we will be continuing to invest in capex. So there will be about 600 to 700 crore capex that we will be doing every year. We have a little bit of back end of the about 4,000 crore capex that we had announced left in the coming year. We also announced about a 400 crore capex in the off-highway tire segment. So the current year will still have some amount of capex that we will do, and then whatever surplus is there, we will look at retiring debt at this point.
Heal, if I may use that word, for the Indian tire industry has been cheap tire manufacturing which was happening in China. That is shifting. You just mentioned that you are optimistic about exports and you are looking at building capacity outside. Where has this China 1 Plus policy affected your business, and how do you see this China Plus 1 policy will affect your business going forward?
Right. So I think largely if we look at the US and European markets, we attend some of these trade fairs, and clearly we are seeing a huge demand for tires outside of China. People want to move out. We're seeing it in the case of truck radial tires in the US, particularly off-highway tires. Anyways, we've seen some success. Now, to start selling to some of these markets, you need to make a very large investment in terms of developing a range of tires that are suitable to that market. So if you're producing tires for India, you can't just say, let me start selling those tires in the US or Europe. The nature of the vehicle, the regulations there are very different. The road conditions are very different. So it takes about a year and a half time from the day you start saying, I want to enter US to enter the US. It also requires a fair amount of capex to get in, nearly about 150, 200 crores on top of the plant investment that you have to do. So we're in process on that. We entered Europe about 2-3 years ago, so we are in a good position out there. Hopefully the US also in about a year's time.
Well, Mr. Goenka, so nice to have you back. Thank you for joining us. And by the way, I always see this Seat timer at IPL. Which team are you supporting this year?
Oh, I think it's for me. It's between MI and LSG.
Am I really the number 4?
I know, but I'm a Mumbaikar, so.
All right, really appreciate your time. So glad you could join us. All right, Mr. Veeras Advani, Vice Chairman and Managing Director of Blue Star, joins us now. Good morning. Thank you for joining us. You know, in middle of the last quarter, when the summer in the month of Feb had hit 40 degrees in Mumbai and Delhi, everyone thought that this would be a bumper year for Blue Star. Just when the summer was getting ready, it has started raining and there was a foggy Delhi afternoon yesterday. So what's happening to business, because weather conditions are so erratic?
Morning, Nikunj. Thank you for having me. So, of course, we'll discuss April and May sales, but first I'd like to take us back to last year. I think we had a record year, so I would like to highlight some of those successes we've had. So we closed the year just above 8,000 crores of income. We delivered 493 crores of EBITDA and about 385 crores of PBT. It really was a great year because we had all our segments firing. You would have seen segment 1, 2, and 3 all growing over 30% in revenue. And also our EBIT margins have improved in all 3, well, the first 2 segments. In the third segment, there's a slight reduction, but that was a planned reduction. You'd also have seen that we've had a great carry forward order book. It grew about 55% to over 5,000 crores. So it was an all-round good year. I think we also invested very significantly in CapEx, in bringing in capacity, part of which will dovetail into your question about the upcoming summer. So we commissioned our new factory in Sri City in January. Production is up and running. Of course, we're all building up. We have high expectations of the summer, as you know. I think Jan to June is how we look at the season rather than looking at it month to month. I think you saw in Q4, as far as air conditioner sales, we grew about 22%. April has been a little slower, as you pointed out. May, only the north is an issue. I think the rest of the country is doing very well. But we're very confident that Jan to June, we should grow at this 20% plus.
Okay. Last year was an extraordinary volatile year for commodities. Metal prices, steel prices, copper prices, and your margins have expanded. Why? How? And how did you achieve it?
Sure. So I'm happy you raised that. So you saw gross margins on. So first of all, to be very frank, last year, so FY22 gross margins were one of the lowest we've ever had. We were severely hit in FY22. So we had an internal plan. Of course, as always, we say price increases we will try and do, which we did manage to do in the first half of the year, but then we were not able to increase prices anymore. We have taken up a fairly extensive and large total cost management program in the company, redesigning products, taking out cost, repositioning products in the market, all based on our significant investments in R&D and innovation. So because of those, we were able to bring down our cost of the products. If you look at the quarter-on-quarter improvements, so for the full year, gross margins would have improved about 50 basis points. But if you look at standalone Q4, you will see a big jump in gross margin, about 2.5 to 3%, if I'm not mistaken. So I think the point is that all the hard work done in redesigning products, taking out cost, has begun to show results. And you can see in Q4 that there's been significant improvement. I think going into the new year, there's no respite on either commodity prices or in terms of price realization in the market. So we will continue to focus on our total cost management initiatives and are confident of improving margins from here.
The other thing I wanted to also talk about, Mr. Advani, is, and please correct us, if we're wrong at this, because some reports are suggesting that consumers are getting very, price conscious, that they are now down trading, avoiding consumer discretionary spends. Is there any truth to that?
So, I'm sure at a broader market, you're absolutely right. I can only speak about, we have room air conditioners, which is a significant consumer product for us, as you know. I would say that consumer demand for air conditioners, and this is broadly industry-wide, not Blue Star in particular, continues to be strong. I know that there have been number of news articles about April being slow, May being doubtful, North being the largest part of the market. So all of that is really weather related. If I step back and I look at consumer demand and try and understand whether a room air conditioner is in their purchase set, I would confirm that, in fact, room air conditioner demand is very strong. I think as an industry, I think we closed last year at about 8.5 million units overall. We're all confident in the industry that we should grow by about 20% in the current year. Like I said, of course, we do need a strong summer. There's no doubt about that. But even if we look beyond that, we still have May and June available with us. Just to remind you, in FY23 last year, June month, you will remember, was a washout. In fact, all our industry sales pretty much happened from January to May. So, of course, given the year, summer does move, peak months move between March, April, and even May. So we will, of course, wait and watch how the North summer unfolds, but we're all confident of a strong summer overall and a full year for this category.
I'm getting a mixed picture about the economy. One side is commercial real estate is slowing down, but the industrial capex is picking up. If you have to blend the demand of, let's say, the pure commercial traditional favorites versus the new demand which is getting generated, how would you map the commercial and the so-called project management business for us?
Sure. So if I go to segment one, I'm happy you brought that. We always like to talk about our segment one, even though everyone is only interested in room air conditioner sales. So as you saw, we had a very strong last year. You saw order inflow up significantly. We have a large carry forward order book. In fact, that the mix of the order book has shifted. It used to be extensively commercial buildings. It could be retail malls, IT parks, hospitals, hotels, etc. That, as you're rightly pointing out, we have diversified that portfolio of projects. We now have a fair amount of infrastructure projects, factories, data centers. These are some of the newer segments for Blue Star. And of course, in line with what you're talking about as far as the general economy is concerned. I think as we look forward, I think real estate, there is some pressure. Of course, commercial real estate, especially because of the IT slowdown, will continue to be under pressure. But, if you look at water projects, you look at metro projects, you look at rail projects, it's all infrastructure. There's no slowdown in capex. If you look at data centers and private sector capex into factories and capacity, again, very healthy. So I would say that we're looking at a positive outlook as far as our first segment is concerned. If you look at our commercial air conditioning business, which is a part of segment one, that feeds a wide range of segments, not just the large capex, but also small and mid-sized capex. And I can tell you that order inquiries are extremely strong when you look at mid-sized projects and regular private capex.
Final question for FY24, how much of the uptick could come as the legacy orders, they start waning down and the new orders would kick in? And also this year, because commodity prices are down, somewhere, you will be getting benefits of that.
So I'm not sure what you mean by legacy projects. We don't have any legacy projects in our order book to talk of. These are all fresh orders received in the last 18 to 24 months. We've been indicating that pricing in the projects business has been good. We've also been very selective about the projects that we have booked. We've been, our focus continues to be on free cash flow in the first segment rather than in volume of business. So that strategy that we've been executing for the last few days has resulted in, what you see in FY23. In FY24, I think that we will continue to improve on margins. If you look at segment results, I think we are looking at least a 0.5% improvement in segment results in the coming year in FY24. So we closed FY23 segment 1 results were 6.9%. I think we should reach up to 7.5% in FY24. And similarly in segment 2, where we closed the year full year at about 7.8%, we should get up to about 8.5%.
So for FY24,
this is for FY24, correct?
FY24, will you say good year, very good year, or strikingly good year?
Well, we in Blue Star, we are always a little cautious, and therefore I would say it's going to be a good year. But very frankly, we are geared up as an organization. We have our capital investments, and we're going full force in that. We have a big program on total cost management. I told you we're investing heavily in our people, in infrastructure, in R&D. I think you would have seen some reports we've come out with during the year of very significant investments in innovation and R&D. So as far as the company is concerned, all investments are in full throttle, and we're looking forward to a good year.
I really appreciate that, because 99% of the managements who come on our channel, they use the word cautiously optimistic. They don't use the word good. So I'm glad you're being honest and being frank about describing the year forward.
Chilled year.
Chilled year. Actually, Aisha Jasing will be chilled year for Blue Star.
Wonderful. I'll take note of that and use that. A chilled year. Yes.
Yeah, okay. Good luck with that, Mr. Advani. Good, speaking with you as always. Okay, quickly, let's take stock of what the market as well has settled in at. And it seemed like a bit of a wobbly start. We're still down about almost 0.5% or so, but we're clinging on to that 18,200 mark. So at an index level, you shouldn't have any reason to complain. Big boys like ICICI Bank, Axis, L&T, SBI are all comforting the index as we speak right now. Today is really largely about HDFC Bank and them weighing heavy on the index. Nothing more to that, really. Manappuram has now tanked 11.6% on the futures. Federal Bank is down 2.6% ahead of its numbers today. And BHEL is now down 6.5% as we speak. Quick break, but lots more managements on the other side.